today. As usual, we try to pick on some of the most exciting, most pressing issues around the world. And today we are looking at the issues of decarbonization, the carbon element, net zero effect, and all the climate change questions, which climate change is indeed a global risk. Number two, the first risk being the pandemic that was causing trouble around the world. But indeed, climate policy, climate change is a very important issue. And we have today two most distinguished researchers who have already produced a lot of work in the economics, banking, finance area, and who are now trying to look at this important question of decarbonization fund and how this affects economic sustainability. Now, for the research seminars, sometimes we have papers which are empirical, papers which may be purely policy and thrashing out the main issues, but also sometimes we bring out some theoretical papers because we need a blend of these different backgrounds to go at the heart of very intricate, timely, contemporary issues. And although this paper is a theoretical paper, it presents a theoretical model, the issues are alive. The issues can be inspired by your feedback, a discussion, your understanding of the issues, because that helps the people building theoretical models to rethink their models and to add some what may be considered as a missing element, if any. So let me take the pleasure of introducing the two speakers. And as you know from the previous sessions of the Center for Global Finance Seminars, Yana is indeed no stranger to this meeting, has been presenting in the Center for Global Finance seminars, and indeed I'm pleased to introduce him as my co-author on a recent paper. He is very well known. He is established a global name recognition professor in banking at the Bangor Business School at Bangor University. And if I could track him way back, he started his career way back as an economist and the Etbank, a banking corporation in Turkey, a research officer within the Institute for European Finance in the UK, and indeed has a BSc in economics from the University of Hacettepe in Ankara, and a PhD from the University of Wales in Bangor, in the alma mater where he works right now. He has authored so many, very prolific author, so many papers, concentrating actually in on banking in particular, the structure and efficiency of banking markets, empirical banking, monetary economics, and now going rigorously into climate change and regional economics. And has been very prolific, hitting the topmost journals in our profession. His work has been published. You couldn't have missed his work over the last, say 20 years, because his papers have come out in top journals: Journal of Corporate Finance, European Economic Review, Journal of Money, Credit and Banking, Journal of Financial Intermediation, Public Choice, Economica. I could go on and on, but we are delighted that Yana could be here to share with us his work basing on his well reputation. And in this work today, Yana is co-producing the work, or co-researching with the Dr. Xiaoxi Q and apologies if my pronunciation of the name didn't come out, very well. But she's a visiting researcher at the Bangor Business School, University of Bangor, and a leading researcher at the prestigious China Academy of Social Sciences. Her main research focuses on monetary economics, regional economics, and climate change, the topic of the issue today. And she has also published in good leading paper journals, Ecological Economy, Financial Theory and Practice, Enterprise Economy, and the Journal of Commercial Economics. So it gives me great pleasure to introduce these co-authors here today. And maybe a minute, if I could do a little bit of, kind of housekeeping. Please post your comments, your feedback in the chat, which is available here in Teams. And at the same time, if you can hold your fire and wait for the end of the presentation, that would be greatly appreciated, because we want to then have a kind of cut and thrust exchange of views, comments on comments, so that we can push the dimensions of this work a little bit further, to also use it to excite more work and provide feedback to the two co-authors in terms of taking this paper to the highest level possible. So please put your hands together to welcome Yana and Xiaoxi. Please go ahead and make your presentation. Thank you very much.
Thank you, Victor. It's really lovely to see all of you, and it's a great pleasure to come back and present our very hot, very new research, initial research papers. It's yes, as you mentioned, I've been present this one before, and also I enjoyed the comments, I enjoyed the companies and suggestion and so on. This is it's a great pleasure to be here to present our work. And then just very quickly, I'm going to introduce things, and also my colleagues is the Xiaoxi, and she's going to take over as Victor said. And then if there is any issues, also we can take the question as we presenting. No problem, Victor. We don't mind. Is there, and then that's also I could say it. Then let me share my screen. I hope it's going to be works. It was, let's see what's okay.
Excellent.
I believe it's we are, is it okay?
Yes, it's brilliant. Yeah, thank you.
Where is that? Thanks again. Let me start. I'm just going to give a little bit background. Is where the idea coming from? Where is that? The topics is the idea come when I was doing work with my colleagues in the BIS on the issues about the macroprudential policies. So I'm sharing on the first slide the BIS the buildings, one of the iconic buildings in Basel. This is a sort of the idea come, especially when we were working and all then we thought about in there is there is a model to show the interrelation, to show the old concept. Then thanks to my colleagues, Xiaoxi, we had a brilliant, she's very good, excellent, and then she's all capacity, all skills. Then we decide we work on when she start visiting in the last September, and we start working on these topics. And then I am going to have a sort of go through, hopefully. So you could see, hopefully, in my second slide, roadmap of presentation. Fantastic. I get the okay. These are the standard presentation. What we will share with you motivations about the literature. And it's a topic. As Victor said, is quite important, and all the colleagues, scientists and economists and all aspects working on the issues, including the policy makers as well. Then we are going to briefly mention about model, calibration of the model, and then some result and conclusion. These are the aiming to get the papers. Possibly, I am happy to sort of start with a relaxing and with cartoons, which is, and we picked up a couple of them as the share with you. And basically, this slide is the framework of our research. And these are the cartoon, four cartoons, but we try to give the message with the message of the model is within this. First one, you can see the environment and industry relationship. It might be biased, but actually is not. Is the industry actually since the industrial revolution is the environment is suffering. Not only the developed economies or regions, it's all over the place. So this is first interaction, is the industry or economic development and environment relation. Then we have the issues about the financial institution, which we are very, very interested in, especially financial institution and linked with the lendings. Then you can see bottom of that is the other intercorrelation or interrelation is the about environment, world, and this is the based in a picture form, cartoon form of our model. And also we are going to present, we will say about the models is a bit further, but what is our motive? Why is we study these things? And then I mentioned about the idea is when I was visiting in the Bank for International Settlements to work on the about the macroprudential policies is around 2016 and 17 period. And this is the topics. Okay, there is some sort of intercorrelation between the finance and environment. Then we also look at the motivations is about the carbon cycle or carbon neutrality, which is the different actually is the technically is different, and also talk about the sort of nature of climate change. And then also we talk about the four elements. Four elements is our theoretical models, and also shocks is we are try to link with the to see as a policy implications. Right. Let's see. Is the timeline? Is the climate change and our environment is suffering since quite some time over the period. There is an international effort, especially our scientist colleagues. They are, thanks to their research, their idea, they are far early start talk about the nature's environment. Is the basic started in the 70s and about global warming and then increasing the temperatures, and then they are the effort they start their approach is quite earlier than the economists or social scientists. We are quite late to take these topics in, especially more research coming up is the post-Paris Agreement, and when the global temperature not sustainable any longer, and now more issues. So the 1987, there is a big effort. There is a combined effort. First combined effort is the intergovernmental level and between. So that's topic started sustainable development. Okay, its economic growth is good. Economic the development is important, but but shouldn't be cost. We shouldn't be expense of the future the futures. There is some first approach or first sort of systemic or very strong movement started late 80s. Then is the timeline, Declaration of the Environment and Sustainability Development of Financial Industry, and especially we are is the in 1992 is the financial institution in relation to UN approach, and they voluntarily declare that they are going to be responsible lender. Then is we have the idea about the UNEPFI, and then the initial all the financial institution, banks, insurance, and other financial institution is the sort of voluntarily accept the idea about the responsible lender. And when they are make the decision, is they will take into account to the future generations and environment. This is fantastic idea, very good, very important initiative, especially when we're thinking about the financial institutions, the big corporations, and voluntarily accepting this idea. Oh, this is too good to be true from my perspective. When I was about to this time, I was doing my PhD, and then I am understanding. I coming from the developing economies, so these are it's very interesting. Voluntarily, they are going to be responsible. That's in the millennium period. Again, there is also further European initiative as well. These are the continued. Then time continue and establish the Kyoto Protocol, and then in the start carbon emission and carbon the carbon tradings is the sort of among, again, within the, between the countries, this the concept. Then 2003, which is the Equator principles, it's been introduced and very sort of further initiated financial sectors, movement of the financial sector. All this concept is voluntary, and as a as the bank as a financial economist, it's very question for me. Hold on, how private entity or private firm objective, that is the to take in the objective as a firm, as a climate change, as a objectives, very it's questionable by me, and sort of we continue. Then the first financial crisis, and all the policymakers moved their attention in a different direction, global financial crisis. Then between those is the very important agreement, is the Paris consensus, is the established, that is the reduction or aiming to reduction of the global temperatures is the about 1.5 degrees in the future date. And as the scientists colleagues is they were pushing, look, this is not good enough, we should do more. Actually, then even 1.5 degrees is not clear, is not acceptable. We should do more. As when we climate scientist colleagues, which I involve as well in another research, is is about the Arctics, the Arctic temperature. When I don't have any slide on that, but I can provide anyone interested in, is the temperature, global temperature is different, increasing differently, heterogeneously. The Arctics is the temperatures is increasing, is the far more than the accepted level, about 1.5. 1.5 is a global average. Then the thanks the agreement consensus is all the government, almost 196 countries initially accepted. Then later on, US, the Trump administration move out or the cancel, or but the new recent Biden administration reinitiate again. Then we have the two important conference, is the Glasgow one, and is the one is the last year, this year, COP27. These two the achievement 21 and 22 is the one is it's give us a sort of motivation to our research. What's important? That there is the sort of decarbonization funds, emerging economies, and they are screaming, or they are saying, well, we didn't create this global warming, we didn't do that. This is you are not expect me to commit it without face the cause. Is the concept, is the who's going to fund this decarbonization policy. This is what is our paper try to put together still. these issues about the carbon cycle and carbon neutrality is they are different. The carbon emissions, naturally, there is the increasing the nature, Mother Nature's also the environment absorb the carbon. What's problem for the is the sort significant additional human-induced carbon emissions. That is our Mother Nature is both sea and land cannot absorb or cannot fix the amount of the carbon that is being human is producing. So naturally there is a increase absorption. Some years is more than others, but the normal is they can be neutrally absorb that. It's the what we as a government, what we are agreed, or what the government is about the carbon neutrality, about the 2000. There is a almost there is a some milestone date in the coming years, 2030, 2035, then 2050, and 2060 is the finally is the one of the big emitters is the China is agreed to reduce the carbon emissions, or these are they all about 132 countries governments is agreed carbon neutrality. So what they emitting, what they absorption, they should be neutral, zero. This is again, it's very big commitment, and it's the hopefully we were expect is the governments, all those continue to their effort. Then we is our living conditions is during the pandemic lockdown is the most of the urban, I mean most of the very crowded cities, they increase, I mean they are improve the air conditions. So there is that possibility that we can reduce our carbon emission. There is a lot of initiatives, but it's the interesting point is coming. Is the like a financial our interest coming up, that is the environment and is the carbon emission. It's not a private goods. It's a public goods. Then that is voluntarily financial institution saying that, agreeing that, oh, we will reduce we will be responsible. We will when we are lending, we are going to take into account this. But when we're looking at the shareholder, manager perspective, corporate governance perspective, shareholder of the banks and manager of the banks or CEO of the banks. But I appoint you there is the maximize my shareholder, not nothing else. I mean, is the why you are focusing on something else, which is I'm not paying you. This is the problem is about the nature, climate, carbon emission, whichever we defining is the environment is a public good, non-competitive and not as exclusive goods. And so this is the issues for us. these are the very important to concept. That's why it's the these are public goods information. I mean, the approach is already in the is in already literature as the so is the those responsible bankers or financial institution profit maximizer. How we are expecting them to sort of ignore the profit maximization, then focus on the environment. This is still is a debatable and is issue. The research is the coming up as the as the as a lender. They can be free riders, or we are as an individual. We can also look at the individual perspective. We can be we can we can we can behave in a differently. We love our environment, but same time we will be very happy to use big polluted big car or and is the run with a diesel engine. We will be happy to drive this one. Is the so is the who is going to this since environment and nature climate is a public good. Who is going to provide this one? Of course, it's the our research, our perspective is there. This should be about the government. Government is they must do something. So, which is all those initiatives, I think, is also confirmed that the government is the what they are, what is the initiatives. So in our research on the perspective, we are going to look at the financial frictions. These are the existing model, BGG models, Bernanke-Gertler models. We take that is the SG models. We are modified, or we improve, or we extend their models on our research. Then concept is the implicit guarantee, and again about to modeling is the which Xiaoxi will be explain you more. So budget constraint is the again these are the fiscal support, and so budget constraint will take the about the linking with the decarbonization and fund cost. Who is going to how we are who is going to a private entity or private firm is the whether how they are going to organize or how they are going to accept the idea. Then also we look at the firm heterogeneity, which is the quite different, and is the bank heterogeneity. Firm heterogeneity, we can look at the green firms and the brown firms. It's already there. There is already a sort of embedded in there. Is the some firms, some industry more polluted than the others, and or the firm shareholder or they have implemented, they might be implementing in a different policies, the same as the banks banking levels, and might be some banks they are more committed than the others. Although we are expecting there is the issues about again is the private public goods is they are the profit maximizer, and then how we are expecting that profit maximizer to take into account in the public goods like environment. So is especially we take the take the unconventional monetary policy in terms of the green credit. This is the to implement in the model and how that being transmitted. So what is the we will take those these 4 elements and insert or extend put it in the DSG model, and then we try to produce policies. Now is we have a 3. Also, we are going to look at the result. It's the 3 shocks, which is very interesting, policy implications, conventional monetary policy, and unconventional monetary policy, and fiscal support. These are the 3 shocks that we are, Xiaoxi is going to present it. Now, I am going to hand over to my colleagues, and then I'm going to change the seat, hot seat, to cool seat. Thank you. I can have my...
Okay, thank you, Yener. Thanks for your presentation about the first part. And now I will continue the presentation about the following part. This is the second part about the literature review. Firstly, we want to tell you the concept of green credit and soft budget constraint. And then we're aiming to find the relationship between financial development and economic growth. And after that, we embedded the green fund. Yes, as Yener told us about the green credit. We are aiming to find the relationship between green financial development and sustainable economic growth. So what is the green credit, and also what is the soft budget constraints? In 2002, Jerkin explained that the green credit, I think that financing green credit mainly means that financial institutions provide preferential credit benefits to green sustainable firms, and at the same time, pass on the concept of sustainable development to lending firms. And in 1980, that Carnile firstly proposed the idea of soft budget constraints when he examined the socialist economy, that he thinks the government cannot commit not to save the state-owned business that are operating at a loss. This is a typical situation in the socialist economy. And then we know there were so many papers that related with the finance and also the economy, such like in the 1873, that Bagehot firstly proposed that the financial development play a prominent role in economic growth. He believed that in the British Industrial Revolution, the financial system played an important role in the promoting the financing of industrial projects. Especially after the 2008, the financial crisis, there is a stream of paper that give the strong relationship between finance and economy. Such like Krugman in 2009, he strongly questioned the view that the financial development is beneficial to economic growth. So he believed that the financial innovation products were excessively complex, which would lead to financial crisis and make the economy retrogress. Last year, in the 2022, as we know that Bernanke won the Nobel Prizes in terms of his BGG model is a kind of the theoretical model. The first B that represents Bernanke, and the second one G represents the Gertler. As I show you here, that in 1999, that Bernanke embedded the financial accelerator theory into the New Keynes model. And then in 2011, that Gertler, they introduced the banking sector into the DSG model to examine the role of bank credit intermediary after the financial crisis. And I also highlight some keywords here. The paper that comes from Bernanke and also the Gertler. such like the keywords financial accelerator, credit channel, and also the aggregate demand, agency cost, net worth, and business fluctuations, credit channel of monetary policy transmission. All of them that emphasize the importance of the relationship between finance and the economy. Based on this, we want to advance, based on BGG model that we want to advance with the introduction of the green credit. Now, this day, we know there are tons of papers with the green financial development and sustainable economic growth. But this paper, all of that are empirical papers, such like the group that's white. In 2002, they studied the relationship between financial innovation and industrial structure and pointed out that the purpose of exploring environmental finance is to penetrate the development concept of environmental protection into the whole environmental protection industry and achieve sustainable economic growth. And also my colleagues, that they also do some papers in these areas. And some others, like Faulkner in 2006, they explain when the green credit policy is implemented, that the companies must disclose environmental information. So the higher the quality of the non-financial information is disclosed, the closer the amount of external financing obtained is to the optimal financing amount, which not only alleviates on the investment, but also avoids over-investment. So above all, we use the theoretical model based on Bernanke's BGG model to find the relationship between green finance and economy. And after the first two parts about the innovation and the literature review, you will know much more clear about the background of this paper. Now, I will let you know how can we use the theoretical model to make that come true. So you can see that 8 numbers here, 7 of them is each sector, such like the household, retailer, wholesaler, the capital, and also the entrepreneurs, banking sector, and the government sector. We want to make each sector partial equilibrium and then combine them together to make them general equilibrium. So in this way, we can avoid missing the forest to the trees. So we combine the credit market, capital market, and also the labor market together. So before we turn to the equation, I want to show you the framework. So this overview is much clearer for you to understand this paper structure of this paper. Although there are so many errors here, but it's really easy for you to understand. You can see the number here is not so important here. It's just the sequence in our paper. Now we can begin from the household. We know that households that they live forever, they work, they consume, they save, and they pay the taxation. And they also want to have the leisure time to enjoy their life. And for inducing the effect that we refer to as the financial accelerator, and also the price thickness and the green credit policy, that the entrepreneurs and bank play a very important role in our model. Now we can turn to the entrepreneurs. In BGG's model, that Bernanke just assumed one single type of the firm, but now we distinguish the firms, distinguish with the entrepreneurs to 2 types. One is a green, who is environmentally friendly, and another one is a brown, who is polluted. And now we can see the entrepreneurs, they at the beginning, they need the original capital, they need the loan come from the bank, and they also need the labor force. And with the heterogeneity of the entrepreneurs, they have the different access to credit to the banks. So we can also say the entrepreneurs sell the capital, physical capital to wholesaler and as the intermediary product to the retailer. This way, the bottom side, that means we have somebody to be the price setter. Now we came about the retailer one. The wholesaler that they sell the products, the intermediate product to the retailer. The monopoly power of the retailer that provide the source of nominal stickiness in the economy. So the retailer that they can set the price here. And then retailers sell the goods to the household, and then the retailer also sell the investment good to the capital producer. We can also say the side of the capital producer, they also obtain the capital, non-depreciated capital from entrepreneurs. And next generation, they will provide the original capital to entrepreneurs. So after this, we can see some importance here about the bank. We are very familiar about that. That's the bank obtain the money from the household about the deposit and also lend the money to the entrepreneurs. And they also need to pay for the reserve requirement to the central bank. And something really new here is this one about the green credit policy here is an unconventional monetary policy. The central bank implements this green credit policy to the banks who targeted to lend the money to the green entrepreneurs. So with this difference, we distinguish the banks with different type. Now we have the heterogeneity of the banks here. And some other errors is here the soft budget constraint that comes from the government directly give the money, give the support to the green entrepreneurs. So this is a kind of the physical support. And the middle one, green credit policy, is a kind of the unconventional monetary policy. And the right side one, reserve requirement ratio, is a kind of the conventional monetary policy. So this way, we make three different policy, three different shocks to combine to find what's the difference of them. So after that, we'll continue about every detail of each sector. How can we use the equation to describe each sectors? Now I will show you briefly. Such like this one. Now the household, as I told you, that they live forever. There are a large number of homogeneous representative households. They want to maximize their utility for the whole life. They must work, save money, consume, and also has the leisure time under the budget constraint. After that, we can find the labor supply equation and the OLA equation, although some others. So this part is the partial equilibrium for the household sector. And then we turn to the retailer sector. This one we can say we should combine the green firms and brown firms. Such like the this one, Y, the subscript, the G represents the green firms, and the subscript B represents the brown firms. We should combine them together, but it's not the linear combined. We should use the CES aggregator of the output of each entrepreneurs. So it's a really new contribution for us in this one. And after that, we want to make the price setter. So we use the cover hypothesis here to make the theta P. That means we cannot change the price with the probability of theta P. So based on this, we can find the Newton's-Phillips curve. This is the retailer sector partial equilibrium. And the third part is the wholesaler sector. It's really easy for us to understand. We can say they get the money, yes, that they sell depreciate capital to the capital producer at price QT, the last one is the last size. And they also sell products to the intermediary product firms at price P. And they also want to buy something, want to buy the labor force, and also want to buy the capital. So they under the constraint of the output. After that, we can find the accepted rate of return on capital goods and also the marginal cost equation. And then we can say turn to the capital sector. To create physical capital, that the capital producer buy products from retailer and non-depreciate capital from intermediary product firms. And this one, the per se means the investment adjustment cost. That means the money comes from the investment, cannot transfer fluently. They have face some thickness here. Yes, that's the friction. So after that 4 parts, something important came about the entrepreneurs with the heterogeneity here, and also the heterogeneity of the banks. Now, when we turn to the entrepreneurs, we can see at the beginning, they have the balance sheet of each entrepreneurs. Such like the entrepreneur's asset, QK, that comes from 2 sides, about the net wealth and also the loan borrowed from bank. Here, I want to explain something about this subscript. I that can change by G, green, and also can change by B, the brown. So this is the balance sheet. From this balance sheet, we can calculate the leverage of each entrepreneurs. So now we should based on the brown firms. It's the original firms that comes from the BGG model. So I will tell you some price here. RK that represents the average return on capital, and the RL represents the non-default loan rate, and also the I represents the opportunity cost. As we know, that's with the information asymmetry, that's between the entrepreneur and banks. We must use a loan contract between entrepreneurs and banks. So how can we use the equation to describe the contract? We can see here, this one omega means the threshold that who cannot pay for the interest and the loan to the bank. So this is threshold. When they face this risk, they cannot repay the interest. So the right side of this one, the right side and the left side, that's the equal. They face the risk. So if the entrepreneurs face the risk, up, that's the this threshold, they can repay for the interest for the banks. But if they are under this threshold, they cannot pay for this threshold, they cannot repay for this interest rate. So combine this together, that they face the opportunity cost for the banks. This is the original one from the BGG model. And then we can see we embedded the green credit here. It seems much familiar with each other, but now you can see some different here. The capital G that represents the guarantee from the government. That means the green credit policy. That means the soft budget constraint. Okay, we can say the lowercase g that represents the proportion of guarantee amount to the green entrepreneur capital income. So when we combine this G into that, we can say from this first equation, the higher the support from the government, the lower the threshold of the entrepreneurs. and the happier the entrepreneurs it is. So based on this, we can say another heterogeneity of the banks is that we choose the bank who targeted to lend the money for green firms and who only lend the money for brown firms. They can also come from the balance sheet of the banks. Now we can see the balance sheet. The central bank has developed a supportive green credit policy and to transfer the liquidity to the green entrepreneurs in order to increase the amount of funding available to and to lower their financing cost. So from this balance sheet, it's really easy for us to know that the banks are constructed by their balance sheet. The asset comes from the loan from the two entrepreneurs and also the reserve requirement. And the liability consists of two parts, the deposit and another one. Each represents the refinancing from the central bank. This is the green credit policy here. Now we can turn to the green banks and the brown banks. We can say H here. I just make the circle here to highlight it. We know that the banks also want to maximize their profit. They get the money come from the lending. So they also have some cost about the deposit and also the cost of the refinancing from the central bank. And also some cost. This cost is the friction comes from such like the second one. The friction means they cannot transfer fluently. Now we assume that they have the upper limit on the amount of refinancing obtained by banks from the central bank. So the amount of green credit refinancing cannot exceed the pledge rate requirement of the credit assets. And further assume that this one, the RH, that represents the cost of refinancing from the central bank. We assume that this cost from the central bank is lower than the deposit from the household. So banks will first obtain the lower cost fund from the central bank and then obtain the money from the deposit. So without the refinancing, the brown banks is really easy to understand. Then we can see the government sector is really easy. The government, they save, they purchase. And after that, we combine the credit market and also the labor market together to market clearing, to make the whole partial equilibrium about the general equilibrium. And after that, we have three shocks here. One is the conventional monetary policy. We use the reserve requirement ratio as an example. And the second one is the unconventional monetary policy. We use the green credit policy. And the last one is the fiscal support. We use the soft budget constraint directly from the central bank to firms. So based on those equations, we should make the calibration and the steady state here. We have already calibrated the parameters common in the new Keynes literature to some standard values, and also some data, and also the base estimation, some authoritative papers. And at last, we have 59 equations and 59 endogenous variables, and also 59 steady state. And then we have 3 extraordinary shocks. At least some calibration parameters here, and also listed the steady state. We put that into the appendix in our paper. So based on those models, we make the shock, assuming about that the policy authority give 1 unit of policy shock. What are the economic impacts of facing this unconventional monetary policy and conventional monetary policy and also the fiscal support, what kind of the behavior should be changed? And after that, we should compare the three policy together to find what's the difference between that. Now, the first one, before we describe this figure, I want to let you know what's the different color of that. The blue one represents the green entrepreneurs, and the red one represents the brown entrepreneurs, and then the black one means the total. Let's combine the blue and brown one together. So we have the one job unit of reserve requirement ratio. So this is one of the kind of the conventional monetary policy. With this shock, what's the problem? What's the difference between different kind of the institutions or the individuals? We show the difference into two terms, the short term and the long term. Short term means when we face this impulse, what will change immediately? And after that, how can they turn to the long term, to the steady state? Now we can say, with the impact of reserve requirement ratio directly, that will affect the scale of banks, of the loan scale. Reducing the reserve requirement ratio, that will lead to credit to expand in the market. Namely, the government should put extra liquidity into the market. So due to the investment adjustment cost, the market liquidity has not been fully released. So the entrepreneurs expanded the investment of the capital factors, resulting about the friction. So they lead to the declining output and also the labor demand in the short term. So result about that, the nominal wage will also decrease. And as we know, we have the friction into the price. So the real wage also decrease. And after that, we know the family's net wealth will decrease as well. So the deposit will also has the same trend. And after that, we know that the bank system adjusts its loan to green and brown sectors. So they reduce the supply of green credit. Since the risk premium of the green entrepreneurs is really high, so the return on assets will decrease. And the net assets suffer, they will increase at the beginning. So the non-default rate will decrease. And then the bank net asset will decrease as well. As we know, the net asset of the bank is an important guarantee for bank to get the deposit and issue the loan. So this is the conventional monetary policy. After that, we can see the unconventional monetary policy about the green credit. Now we give the shock about the refinancing rate increase 1 unit. What will change? When we say that refinancing rate for green entrepreneurs increase, that the loan scale will increase sharply, especially for the green entrepreneurs. And then the financing cost of the green entrepreneurs will decrease. So the output of them will increase at the first time. Due to the crowded out effect, the outcome or the output of the brown firm will decrease at the first time. So with the demand of labor and capital increase of the green entrepreneurs, we know that the labor force will flow from the brown firms to the green firms. And after that, we know with the demand of the labor increase, the price of the labor will increase as well. So the nominal and the real wage of the labor will increase. And now something is really interesting here. The last two figure we can see. At the beginning, that's the banks who can get the refunding from the central bank. That means the green credit will increase sharply. So when the bank can get the lower cost of the refunding, they will not tend to get the deposit from the household. So the deposit for the green banks will decrease sharply. So they are in the totally different trend. So after that, we can say the long term. As we know, the amount of green entrepreneurs loans surged, resulting in a sharp decline in net asset and an increase in leverage. So the borrower's net asset will decrease, and as well as the non-default rate decrease as well. So increase the risk in order to pay for the expenses of the monitoring. So after that, every size will turn to the steady state. So the third one is about the fiscal support. The fiscal support means the support comes from the government directly to the green entrepreneurs. That will provide the guarantee for the green entrepreneurs with the support of the government. So the non-default rate will increase. The threshold will decrease. So the happier about the green entrepreneurs. But as we know, with this support, we face some problem about the mismatch and distortion of the price. So the outcome will decrease at the beginning. And then we say the capital return of them will decrease. So because of the government directly provides the financial support only to the green entrepreneurs, so which lead to the bad situation of resources of the mismatch and the price distortion. So return on assets corresponding to loans decreases, and net assets of banks will have the corresponding losses, and then everything will turn back to the steady state. Above that, we combine three policies together. We can see the solid line that represents the conventional monetary policy, and the broken line represents refunding about the green credit policy. And also the last one, the dotted line represents the fiscal support. So we can say who that has the large fluctuation about the solid one. We can say the conventional monetary policy has the weakest economic stability effect, which leads to large fluctuations in output and inflation. And after that, we can say the second one, unconventional monetary policy. They can stabilize the economic fluctuations quickly. Similarly, that the unconventional monetary policy has reduced the long-term negative impact on the economy. And then we turn to the last one, the fiscal support to green entrepreneurs, resulting in the mismatch and the resource and also the price distortion, which can lead to the inefficient that the use of resource and they have the negative impact on the overall output levels. So above all, we know unconventional monetary policy, the green credit policy, is more effective than the other two shocks, which can better balance the two goals of economic stability and also the green industry upgrading. They can enhance the control effect for micro policies and promote sustainable economic development. So that's the conclusion of our paper. Now that's it. Looking for your comments. Thank you. Okay.
So let's put our hands together and congratulate you, Yanan Shells, for brilliant presentation. And let me find the applause. That's right. Okay, to give you the applause. Basically, this is an absolutely interesting paper and presented so methodically and clearly. So it becomes interesting, of course, very relevant, because basically the literature review, first of all, the motivation, interesting and well presented. The background literature, very well discussed. Now, the model and especially the key equations, the main equations, presented in such a way that, it's very clear what is being discussed. This is always the difficult part to kind of present, especially in a theoretical model, but it really made a lot of sense. Very comprehensive framework of equations and very interesting results, which will have great implications for policymakers. Now, let me first check in terms of the charts. No comments on the chart. I think the only comment was from me about putting into perspective the 1992 Rio Declaration, the polluter pays principle. Those who produce pollution should bear the cost of managing it to prevent damage to human health and the environment. It's the polluter pays principle is just a set of broader principles to guide sustainable development worldwide. In a way, you say model capture that because you have a government sector, and you have allowed in your impulse response analysis the fiscal support to green entrepreneurs. I guess this is a kind of redistribution. The green entrepreneurs are not polluting the environment, but there might be some producers who are polluting the environment, and therefore it's just a transfer cost to support sustainability. So maybe the PPP at the time of when I posted this, we hadn't got the discussion to look at the equations. But given what you presented, the government sector is one of the key ingredients of the of your model. So maybe the polluter pays principle is already taken into account, and there is an effort of redistribution. Maybe also some of the observations, if I could say, what is interesting about the model and theoretical framework is that it could easily work for a developing countries as well as industry economies. Of course, with some adjustments, because maybe some of those sectors will not be highly amplified. But it's a sort of model that can be widely adopted by national authorities or multilateral agencies to actually address this question. I should quickly say that this whole idea of bringing climate change into financial framework is very much motivated in the paper, but is also gaining currency. And indeed, I picked from the slide something about green financial development, which was so exciting for me because, basically this is, bringing to life some of these perspectives. So, okay. So I'll open up the discussion to the floor, and I can see already there is a hand up. This hand is came from me. Okay, so I have to not keep it raised. I have to raise to lower the hand. Let me see. Okay, it's gone. Thank you. Okay, so let me invite comments, observations, feedback. So far, no hand in the chat. No hand in the, okay. Let me continue making some observations, and then we can get some reactions, maybe from the floor. Another interesting part, there are so many interesting parts of this paper, by the way, especially thinking about the theoretical way of underpinning the main aspects of the analysis. But one of those I was looking at was the configuration of a conventional monetary policy it is true that reserve requirements an important part of a monetary policy. It may well be the case that monetary policy, especially as currently implemented in the current environment, has been actioned through the simple tools of prices, that is changing the interest rate. And if you note what is going on globally, that almost every morning, if you look at the global landscape, almost every morning, you'll get a report of a central bank somewhere, Chile, Argentina, changing the interest rate. The US is going the Bank of England, when the monetary policy is changing the interest rate. So I'm not thinking, and this is what all seminars are about. You get the concepts, and then you think, would there be another way? Maybe one could be that if we capture this through, suppose we reconfigure this, a hike in the interest rate as a conventional monetary policy, what would change? This may not be a fair question because basically you can only play around with one change at a time. So you could reserve requirement is highly credible as a policy. I'm thinking very loud in terms of what would happen if we actually converted a conventional monetary policy into interest rate hikes, because they are most common. That's kind of question. Yeah, yeah. Okay. Maybe we can talk about that. Meanwhile, we wait for to see reactions from the.
So Victor, you are saying is the instead of the reserve requirements.
Yeah.
And then if we introduce the interest rates, I mean increasing the interest rates, what will be the outcome? Is there any we didn't think about it, but is there any
policy interest rate?
policy interest rate?
Yes, it's also the instrument of the conventional monetary policy.
Yes.
So we
yes.
just
yes.
choose one of that.
Yeah.
For example, so if it's not so hard for us if we want to change that for the fiscal policy. We can also use that to be the one of the sample to compare them together.
Yeah, yeah. My hunch, would be that okay. First of all, it's certainly very much a big shock now, post COVID-19, because we moved from before COVID, it was zero bound interest rates. Interest rates were almost coming to zero, globally. So there would be less maneuver with interest rates. A reserve requirement would have, could be a shock that can represent some magnitude. However, post-COVID, that has changed slightly in the sense that it's a question of hiking interest rates rather than lowering interest rates. That shock has hit almost every economy in the world. And yesterday, so from Bank of England, was this worry about mortgage rates, the way it would, how it's going to affect mortgage rates. I think with respect to your model, maybe it's possible that a hike in interest rate, since you are basing on a profit maximization, the optimization from equations, maximize profits subject to budget constraints. It may be the case that this would actually bring down profitability. It would cut into the profits of of enterprises, and therefore it would then have various. But the immediate one would be lower profits. Maybe output will contract, and inflation would go up. So that would then, generate maybe results different from what we expect. Because I thought the initial impulse response there was, a boost in a output, inflation changed, but later on, leveled out, especially for green farms, but maybe that's what it will change, that they hike. We maybe we don't know until you do the impulse response experiments later on. And then what I like about your model has a good structure. You're comparing the green, you're comparing the brown, and therefore you can, and then the total, so you can see the kind of total impact. Yeah, yeah. Okay.
She is raise the hand. Then
Yes, yeah.
Yeah.
Thank you very much for a very inspiring work and a presentation. I was very interested in knowing more about the definition of green firms and the brown firms. So, what criteria do you use, or in general, like people use to define those two categories, and whether the change of the definition would have impact on the monetary policy? So because one question I had in mind was in terms of green firms. So for example, if companies, organizations that they produce solar panel or electric cars or devices using green energy, it might sound as green firms, but the production of the products or the disposal of the products, for example, the batteries of electric cars, they could be a source of pollution in a sense. So how do we define what is completely green and what is completely brown in a sense?
Yeah, is the for maybe this on this paper a little bit it's not important what is the exact definition, but in the other research that is what we are, how we define the green, how we define the brown firms. We paper that is the we publish it, or we are about to publish about the, we took the several measures. One is the UN measures about the industry, how they, what they define the UN is to define the this SIC, based on this SIC code, the UN take as the brown or green. The other another measure that we use on the other research is that we use directly carbon emissions. Carbon emission, which is the scope 1 and 2, is the combine of the scope 1 and 2 total carbon emission of the firms based on the total emission. We basically higher the carbon emission, higher the pollution. This is where we use an alternative is the more quantitative measure we use instead of the SIC code. We don't know, but we can have a direct measure, which is which was like a total carbon emission. This
And we have already found some documents, some official documents that they told us some kind of the firms, the green one and another one is a brown. They make the score for different kind of the firm with their disclose of the information, such like ESG, the score of that.
Yeah, that's also we can, but I think what we can use other research, which I can share on that as well. It's just the total carbon emission to use as a green, brown, and UN definitions is the based on the SSC codes.
Thank you very much.
Our pleasure.
Excellent. Thanks very much, and Meng, for that intervention. And indeed, if this the approach in the study, if the model was to be estimated, on farm level kind of data, that would be absolutely a kind of problem, because then you have to classify farms. So absolutely relevant. Okay, I can see a hand up. Athena, please go ahead.
Yes, thank you, Victor. And thank you both for a brilliant and very interesting presentation. So I was just wondering whether the effectiveness of the green credit policy, I mean, there could potentially depend on macroeconomic or country-specific factors. I mean, is there a reason to believe that the effectiveness of the green credit policy could potentially depend on country-specific factors? For example, I don't know, the level of the pollution produced by central countries, for example.
Whether we can look at this, well, at the moment, it's the model, theoretical model, which is we take the let's say, assuming that is the country level or global level, whatever they are. And we take these are the inserted in the fiscal policy in the model. But in the we have not I mean, we haven't done, or we haven't extended this empirical paper, which is the something that is we could show on the empirical doing analysis as which is I am expecting what you are from your question, effectiveness of the green credit policy based on the is there a country level differentiation? Possibly yes, because it's the culture or approach, and then developing and developed countries, there could be differences between the policy or how effective disclosure, firm disclosure, and how good is the friction of the, which also Xiaoxi mentioned about some frictions, maybe direct fiscal help or credit might receive it, the firm might receive it, but whether this credit will be used for the decarbonization or reducing the carbon emission, we don't know, or it might be different. If the I'm just thinking about the research that is the other research that I mentioned earlier about the SMEs decarbonization policies and how the government help or government support, then obviously there will be difference in there. But on this research, we didn't introduce. Am I correct? And is the country sort of differences?
Yes, we don't compare the different country level.
Yeah, but we didn't introduce another sort of
carbon emission, the spillover, or some other.
Yeah, that's no, we don't have that in the model. In the more, this is a very purely focus on is the one country or one sort of area. And
Excellent.
And also
Excellent.
I have all those sectors as different sectors.
Yeah. Absolutely, the model is absolutely a comprehensive in that regard, covering main aspects of an economy. And interesting, you know, that's what struck me as interesting are the results. Both when you're looking at conventional monetary policy, but what comes out important is this unconventional monetary policy. You know, as you do share on this slide, especially since there has been literature, I think, for almost a year now, about integrating climate change into central bank policy formulation, or recognizing the importance of climate change in looking at financial policy. So actually, this paper comprehensively does it. It fills a very important lacuna in what people have been discussing. It brings everything together to a framework. On conventional monetary policy, and then a fiscal policy, fiscal support. In fact, I got carried away, by the way, I should confess, I got carried away. I was listening to the paper. I say, you could even have a type of, say, like unconventional fiscal policy. So what you have here is this conventional, fiscal policy. In fiscal policy, you have either taxation or you have the negative taxation, which is a subsidy. Okay, so here you have a fiscal support green entrepreneurs would be like a subsidy, and your result is consistent with conventional economic policy, whereby subsidies could be distorting. Okay, but one could think of, say, unconventional fiscal policy. For example, we know for some time there have been countries have been issuing green bonds. Okay, they have been issuing them as green bonds. Okay, and it's the governments and the central banks which issue the bonds. It's a fiscal policy instrument, basically, of raising money. But they also bonds targeting climate change, like cat bonds, catastrophic bonds. And basically, if there's some climate change and there is a natural disaster, as we saw last week in one of the papers, then governments can issue catastrophic bonds, just raise money for mitigating the adverse effects or addressing the adverse effects of it. But if these bonds raise money, they involve a coupon rate, and there is paying back on that or on the amount of money borrowed, and maybe the results of the green bonds might be much more palatable, might be much more positive than the fiscal support of green entrepreneurs, which is a negative tax, which is a subsidy. I don't know. I just got carried away and started thinking about it. And of course, if it doesn't make much sense, you can always include it as a footnote.
Yeah. Is what we are looking at in here, which is a slightly different question, is the green bonds and bonds and lending other direction. But is what is something like a fund, let's say government or central banks, which is more and more central bank introducing the funds to decarbonization policy. And this is the one things that is we are interested in. How effective, which policy will be better? Is it just leave it to financial institution make the decision, or fiscal? This is basically is the fundamental of or innovation of the paper. So how, let's say, Bank of England introduce bring up the X billion of green fund to distribute. So how that is going to be that? Are they like China is said, oh, we are going to use the bank lending channel, banks, but banks, we are going to make a choice. Some we got discriminate sort of the one policy. This fund will go through the specific financial institutions, and ECB has also have the fund, but I think they are. I didn't go through their policy how they are going to distribute. or is it a direct fiscal policy, or something like the treasury, or in the give money like a fund, give the money to firm. Okay, take this money and to achieve the goal, decarbonization. This is our paper or our research is to try to fill up this gap.
Yeah. So I think that's a very important clarification. Thanks, Sienna. If we focus on the decarbonization element, everything becomes clear. It's, I think, of in listening to and looking at the paper. As I said, I got carried away into getting carried away in a seminar, interesting seminar like this. Is part of the action of the seminar. In the sense, you start to look at other ways of looking at the same question. But I think it's the decarbonization that we are trying to investigate, and these things are very clear. So I think maybe I give you 1 minute to conclude before I just move a vote of thanks, and then we can close the seminar. Yeah.
Well, colleagues, thank you very much for the listening, and then you are the almost first academic colleagues to listen to this research, which is great. I hope if you have any comments or anything that is there, we are very, very happy to receive it, either our emails and our contact details. And is there if you spot anything, any suggestion, it's a preliminary research. We will be very, very happy to take into account your effort, and we will acknowledge it, which is already acknowledged all of you to listen us, and then giving us the opportunity to present such a audience in here. But if you have any comments or any further discussion, we will be both as Xiaoxi and myself very happy to communicate.
Thank you indeed. So let me have the opportunity of thanking you both for a very interesting paper. It's very it's contemporary, because this is one of the leading issues. It introduces us in very important methodology of taking whole model and then doing the impulse response functions. Yes, we'll continue to feature some of the climate change issues into the Center for Global Finance discussions. We thank you for sharing the work with us. We shall create a video out of it and on YouTube. Indeed, the feedback will be continuous. Behind the scenes, we have also been sending out messages about the seminar way back on Twitter, and Asena has been very active, so you might get some of the Twitter feeds coming out to you in terms of the people who have been listening in, maybe either with questions or with some kind of feedback. Secondly, let me also thank the participants who've been here with us throughout the entire session, and once again, thanks, very much. So it's my pleasure to conclude this seminar, and we look forward to seeing you again next week. We actually still have a couple of issues on climate papers coming up in the subsequent seminars until mid-June, which when we close. Thank you very much. Thank you.
Thank you very much.
Thanks a lot.
Thanks for everyone.